Hello everyone, welcome to part 2 of our discussion about liabilities. In part 1 we dealt with liabilities that arise kind of in the normal course of our business. Here we're going to actually talk about the idea that we need more assets and therefore we've got to go and borrow money. So we could either get that investment from our shareholders, but we're focused here, and that will be getting from our shareholders is next chapter. This is about borrowing money. So we're going to go to a financial institution of some sort. It could be another individual, and we're going to borrow the money. There's going to be some kind of agreement. This is going to be evidenced by a loan or a note payable, is usually a term we use. If there is real estate involved, often we refer to as a mortgage. That describes the idea that they can take back the real estate if you don't pay it. Okay, so you'll see those terms: loan payable, note payable, mortgage payable. The idea is you're going to pay it back with interest. So the important concept is calculating and recording interest. So you need to know how often that's paid, what rate it is, all that type of thing. So this is a little higher risk than getting it from your shareholders, because if you can't have difficulty financially, you still have to pay it back. So it doesn't matter whether you make money or not, you've got a contract to pay it back with interest. However, on the good side, once you've paid it back or paid the interest, any other amounts you get to keep, the company gets to keep rather than sharing it with other shareholders. Okay? So, some terms. The idea of bonds is another form of loan. When you hear the term bond, that means basically the same idea as a loan or a loan payable. They even can be traded publicly. So they take a big loan and chop it up into pieces, kind of like shares of stock in a company as a piece of the company. Okay. A bond is a piece of a loan. So rather than getting the loan from a single bank or a group of banks, we get the loan from a bunch of individuals who each have made an investment in a bond. All right? So all of these situations have a contract that spell out the terms, tell us how much interest, when it's due, when the whole thing is paid back, because there's always going to be, with these types of loans, there's ultimately going to be a payback at the end of the term. So first of all, talking about bonds, a couple of things. The contract is called the indenture. There's a term, there's a vocabulary word for you. Indenture is simply the contract between those that have the bond and the company that is borrowing the money. It's a little confusing because we use the term issuing or selling bonds. Sounds like revenue, and I have students that get that mixed up because we're selling the bonds, but what we're really doing is borrowing the money. As a company, we're giving them a certificate and they're giving us money. So yes, we're selling them that bond certificate, if you will, but all that bond certificate is basically evidence that they get to receive interest and payback. Okay? That contract or indenture states how much will interest will be paid. There will be a contract rate, and that will be multiplied by the face value. And that will be stated in the contract as well, the face value. And how much will be paid back. Typically, face value and maturity value are the same amount. And that's what everything is based on. And it's usually nice round numbers like 1,000 or 1,000,000 or something like that. It tells us when the interest will be paid and when the bond will be paid off. That's called the maturity date, when it will be paid off. The most common form of this is a term bond, which requires only interest payments until maturity. So they pay interest only, typically every 6 months, and then pay the whole thing back in one lump sum at the end. That's how a term bond works. So we need to, if we have a term bond, we need to record the interest payments and then we need to record the ultimate payback of the loan at the end. So regular interest payment, debit interest expense, credit cash. Okay? However, if time has gone by since the last payment and you need to make financial statements, you must do a adjusting entry. So if you paid interest on November 1st, let's say, to those that you owe the money, and it's been November and December, and you're going to do a balance sheet on December 31st, you need to have recorded an adjusting entry for interest for November and December, even though it's not going to get paid till the next year. You still owe it. So we're going to record it as a debit interest expense and credit interest payable. When bonds are sold in between interest dates, then some of the interest is charged to the buyer. So if I sell a bond that has a date of April 1st and I sell it on June 1st, then the company, remember, selling it means we're borrowing the money. So we had a delay from when the agreement started to when we actually did the borrowing. To make everything work, we charge the people we're selling those bonds to or borrowing the money, they lend us an extra interest for those 2 months, April and May. And we credit that to interest payable. Because we're going to basically, at the end of this first 6 months period, pay that interest all back to them. So interest is always calculated by taking the bond value, face value, times the contract rate, and adjusted for time, if it's less than a year. So if we're trying to figure out interest for a month, we will always have the interest rate on an annual basis. We'll multiply by the interest rate, we'll divide by 12, multiply by the number of months that we're talking about. So in the case where we sold it in June, that we would charge interest for the 2 months by taking the face value times the interest rate, contract rate, divide by 12, multiply by 2. Now, when bonds are sold and invested, when people buy them, they're looking to make an effective interest rate or a market rate. This is the rate that the lenders want to earn on lending to the company. And this can change. The rate on the contract in the indenture will not change, cannot change. Once we've signed that contract, that rate cannot change. All right? So when we want to borrow money, we're probably going to establish a contract rate that we think is very close to the effective or market rate. But that, because the market or effective rate can change and our contract cannot, all right, then we may have to adjust the price that we sell the bonds for, or adjust the amount we're going to borrow, because we can't adjust the interest rate. So if the effective rate and contract rate is equal, everything works out easy. If it's not, then we have to calculate using present value tables or present value in Excel. We need to calculate the value or the amount that we're going to borrow from the investors, based on the effective rate. So, calculating the amount we're going to borrow or the price of the bonds. And I know this sounds like we're selling against stuff, because that's the process. We sell the bond certificate and they give us money. That's how we do the borrowing. The price of the bonds equals the face value times the contract rate times the adjustment for time, usually 6 months, so usually we're doing it for a half a year, times the factor from the present value of an ordinary annuity table. These tables are in your textbook. I will also show you in the next podcast how to calculate this using Excel. Plus, and that's the thing that sometimes we forget, there are two pieces. The face value or maturity value, which is usually the same, times the factor from the present value of a $1 table. All right? So you look at the table, you have to do two calculations. You're calculating the present value of the interest, and you're calculating the present value of the final principal payment. So what factor do you use on these tables you see in the textbook? Use the column for the effective rate and the row for the number of payments that will be made. So if the effective rate is 10%, but it happens you're getting paid or paying the interest every 6 months, then the effective rate column you should use is 5%, 10 divided by 2, because there's half a year. And if the bond is 10 years old, or it was going to last for 10 years, and you're making payments every 6 months, that's twice a year. So the number of payments, the row should be 20, not 10, even if it's 10 years. So when you have calculated this amount, when you've gone through and figured out the present value, then you need to debit cash and credit bond payable for the same amount. So it should be a debit and a credit for exactly the same amount. Now, when you pay interest on that bond, it's not quite as easy as our earlier example where we just debit expense and credit cash. We still credit cash for the payment of interest. That part of it is the same and is always done at the contract rate because that's what we actually pay. But we debit interest expense for an amount that is equal to the bond payable times the effective rate adjusted for the time period. The difference between what we did in step 1 and step 2 is either an increase or decrease to the bond payable and that becomes our new bond payable to calculate next payment. Okay, when we do this all again, in 6 months from now. Okay. So the hard part really on this is the difference between what our interest expense is, okay, and what cash we paid, and if you got a debit or credit to the bond payable for that. All right, the next kind of loan is an installment loan. Now this is going to feel more familiar because this is the kind of loan you're most likely to encounter. You pay a set amount every month. You borrow an X $50,000 and you pay it back over 5 or 6 years. Each month you're paying principal and interest. So each time you make a payment, the amount that you owe goes down. That's what we refer to as an installment loan. You're paying it on installments. The payment can be determined using an Excel function PMT. I'll show you how to do that in our example podcast next. When we make the journal entry, we debit interest expense, debit the loan payable, right? It's got to go down. It's going to reduce the amount we owe. and credit cash. The credit to cash will be the same every month, but the debits will be different amounts. Always calculate the interest first by taking the loan payable balance times the interest rate just for the time period. Usually you're going to divide by 12, right, because it's a monthly payment. But sometimes it will be an annual payment or a quarterly payment, and you won't have to worry. You'll have a different adjustment. Whatever your payment was minus the interest you calculate is how much principal. So payment minus interest equals principal. An example, $50,000 for 10 years, 8% per year with a monthly payment. We use the PMT formula in Excel. We put the 8% divided by 12 because it's to get a monthly rate. We take the 10 years times 12 because we make 12 payments a year, so we get the total number of payments of 120, and the amount we're going to borrow is $50,000. We put that all into Excel, and it tells us that the payment on this loan will be $606.64. Interest expense is going to be a debit for, you see the formula there, $50,000 times the 8% divided by 12 to get monthly amount. The interest is $333.3. We paid $606.64. The difference is $273. That's going to be principal. That's going to be a debit to the loan payable. Credit cash $606. Notice for the second payment, there is still, the cash is the same. The difference is the interest expense is different because now instead of being $50,000 we owe $50,000 minus the $273 that we paid off with the first payment. So we have to recalculate the interest. And that means our principal payment on the second payment is going to go up. So in an installment loan, interest expense goes down each time, and the amount of principal we pay goes up each time, each payment. So for the third payment, the interest expense will be less than $331, and the principal payment will be more than $275. So one last kind of borrowing that we want to talk about throughout there is leases. Very common way for businesses especially to obtain equipment or buildings or whatever they need is the lease. It's a little more flexible typically in the terms than a regular loan, but it works very similar. So FASB determined that we should look at two different types of leases. Now, when we're talking about leases, we're talking about anything that's longer than 1 year and cannot be canceled in the contract. So this is not month-to-month rent. This is not a short-term, I need some warehouse space for the next 3 months. This is for anything that goes a long-term and that is you signed on that you're not going to break the lease. When that happens, even though technically you haven't bought the building or bought the equipment, if you control it for that long, it's considered an asset, and you are going to record the asset and the liability. If it's a short term, it's going to be rent expense. But if it fits this definition of this lease and we record an asset and a liability, then it either is a finance lease, and the way that we have finance leases is if the ownership transfers at the end of the lease, or we get to buy the asset for a significantly reduced price at the end of the lease, or the lease is most of the useful life of the asset, or the present value of the lease payments is almost all of the fair value of the asset. So basically it's the same as buying the asset. Then the finance lease looks just like an installment loan. It's just another type of installment loan like we talked about in the last slide. And you would do the breakdown of each payment into principal and interest the same way. If it doesn't fit one of those four, it doesn't fit any of those four things listed under the finance lease, then it is an operating lease. There's still an asset or a liability recorded, but we don't record interest, we record lease expense. And each month when we pay the lease, we reduce the asset and liability in a way that we will learn in a later accounting class. But I want you to know that leases, for the most part, are going to be finance leases, and they're going to look very much like installment loans, since most of them fit one of those four things. So we're going to have Excel spreadsheet in the next podcast showing calculations and journal entries for an example of bonds, installment loan, a lease.